All I want to say is that for anyone listening or watching, Josh is truly an expert at what he's about to tell you. And this is the number one reason that real estate is the best investment of all time. You talk to really any investor, and it boils down to real estate. You talk to most business owners after a 30, 40-year business run, and they'll say the best investment part of their business was not selling a business, it was paying off and selling their real estate. And what he's about to show you is the underlying reason that that works.
Hello, and welcome to another episode of the Infinite Financial Freedom Podcast. I'm Josh Metal, and we're excited to have perennial podcast all-star Jake Breen back with us today. Stoked to have you, my friend. Welcome to the show.
Hey, thanks, man. Happy to be here. We're always thinking outside the box, so I love our discussions.
We had to think way outside the box for this one, Jake. Yeah, that's a good way to kick this off. Let's set this thing up. Those of you who don't know Jake, by the way, Jake is a local real estate broker here in Salt Lake City. He is a brokerage owner. He has his MBA. He's a real estate investor. He's been in the game at pretty much every level for a long time, as you can tell by our salt and pepper hair nowadays. And what I like about Jake is that he not only understands it, from a numbers side, from an intellectual side, but he actually has skin in the game. Like, he and I have virtually all of our net worth in our real estate investments. So, there's no better way than to mess up and make mistakes with your own money. And we've done plenty of that. And we want to help you avoid that. So this episode, I invited Jake to come on and talk because, Jake, we work hard, man. We're analyzing a property probably at least every month, sometimes every week. We're analyzing property. A lot of our investments over the last 5 years together have moved towards commercial buildings, retail centers, apartment buildings, office buildings, medical office space. But over the last couple of years, the last 18 months specifically, since mortgage rates have climbed so much, it's been difficult to find something that pays a decent cash on cash return, and let alone something that you can make double-digit returns. So we finally found a deal in the last part of 2023, and the strategy is pretty cool. So we thought we'd do a podcast on it and share with you how you might be able to earn double-digit returns in real estate investment despite these challenging mortgage rate environment. Jake, what would you add, buddy?
Yeah, and I would say to our listeners, when Josh says we analyze a deal once a week or once a month, when we do our own due diligence and we're putting our own money, or say blood, sweat, and tears as well, into some of these larger size transactions, an analysis is not looking at the online profile of the property. It's typically 2 to 4 hours of us extracting the financial information and putting into our own curated spreadsheets. Or in fact, we create a really cool, very in-depth online calculator. We're going to share that with you today. And I'll tell you, we have an 8-year in a row track record of acquiring a deal that we were happy about. And all 8 years, those are larger transactions, some larger multifamily, but mostly in the commercial space, as Josh mentioned. And in 2023, come November, we didn't have a deal, and we had analyzed probably more than we ever had in any prior year. And the biggest reason for that, we could dive into all the little innuendos, but the biggest reason is pretty simple, and everyone knows this right now. They just don't know what to do about it. Yeah. The biggest reason was interest rates.
Yeah.
Anything could look, pretty darn good from a rent roll standpoint or location standpoint or a vacancy standpoint. And then you do all this work and you go, well, gosh, if the interest rate was 3 point something, this would be a phenomenal deal. At 7 point something, it doesn't even pencil. You'll lose money.
Yep. Yeah. You're spot on. And, we didn't want to goose egg last year. I think one of the biggest mistakes, somebody asked me on a podcast a week or so ago, they said, what would be one of the biggest mistakes you've ever made in your investment career? And the biggest mistake I think I've ever made, Jake, is I checked out from acquiring properties from about 2010 till I think 2014.
Mhm.
I was so fearful. I was just, really just in a place of feeling like the world, after the Great Recession, there was just such a feeling of scarcity.
Yep.
And in retrospect, when would have been the most epic freaking 4-year period ever to buy real estate?
The absolute best. I mean, I had the exact same mindset. And at the time, I was a professional and very involved and it touched all aspects of the business. I had just finished being the managing broker at Sotheby's, a new brand brought to Salt Lake. I was the broker at Berkshire Hathaway. I was with top agents. And I will tell you the mentality when the Great Recession was maybe 6 months in, let's talk 2009, was just that. I mean, people in the industry were saying the market will never go back
Yep.
where it was. And I too, biggest regret of my career, didn't really buy anything in that 4-year time frame except for one thing. And it's my personal home lot where I
Oh,
live
wow.
right now, where I built my house. And it's the best deal I've ever done. I mean, you wouldn't touch a lot in my zip code in the last 20 years for what I paid. And it was because of that mentality. I mean, Warren Buffett said it best: be greedy when others are fearful, and be fearful when others are greedy.
Yeah.
You know what? But there's so much information about that. But the reality is, when you're spending your own money, even if you've read those books and you subscribe to Warren Buffett, it's really hard to do. And
It's hard to
so
do.
today, I think, we'll dive into other angles that you should be considering and looking at when you've got that fear that brews up, because there's always a way to do it. And when there's a large majority of the people thinking one way, that's going to breed more opportunity for you to do something. It might just be a little outside of the box.
So I think that's the first lesson here, Jake, is don't check out. Like, even if you don't think that, if you're not finding deals that make sense, keep doing the work. Keep thinking, how can this work? What else might also be true? What am I not thinking about? Is there somebody in this environment who's been able to figure it out? But don't, if you're on your investment path, don't allow shifts in the market left or right get you off of the investment track, and especially don't allow you to do it as many years as I did after the Great Recession. So, all right, Jake. So let's I'm gonna share my screen. And by the way, this is the first residential property that I have acquired for long-term investment, probably since 2016. I mean, we've been almost
Yep.
exclusively into commercial. And so we're really doing an end around here. Like, okay, well, what else is out there?
Yep.
And this is, I'll just share my screen. So those of you on YouTube that are watching us live, you can get a little bit of an idea. This is a townhome down in Lehigh. And we were able to negotiate a little bit better deal than what the valuation shows here. I think we ended up paying, did we pay 400 for this, Jake?
Yes.
Yeah, 400. It's in very nice shape. You can tell by the pictures of the kitchen. It's new construction. It's in pretty darn good shape. We did a light paint. We did just some kind of touch-up stuff, but really the house was in pretty darn good repair. So we didn't have to do a lot of maintenance. But here's the deal. As we looked at these numbers and looked at what the cash flow would be at a 7.5% interest rate, which is what it was in the fourth quarter of 2023, there was like zero cash flow here. You would have had to put down 30 or 40% just to break even. I don't subscribe to parking large amounts of cash without getting cash flow back for that investment. I want a cash on cash return. One of the things that, as we went through the Great Recession, my mom and I at the time I think we had like 57 or 63 single family residences. And at one point, we looked at the value of those properties and figured out we were well over $1 million upside down, meaning that our mortgage balances were $1 million more than the value of the homes. And while everybody around me was giving properties back to the bank and doing short sales and foreclosures, Mom and I made it. Well, why did Mom and I make it? Well, because every one of those properties had positive cash flow. Some of them not a lot. Some of them $50. Some of them $150. Some of them more. but the positive cash flow got us through that period. And I thought, why was everybody giving all their properties away? If I still have a positive cash flow, why wouldn't I just ride this out as long as I possibly can? So cash flow is key if you want to make it through a market correction, is my point.
Yeah. You're also addressing the second rule. The first one we just talked about was, greedy and fearful timeframes and thinking out of the box. But the second thing I've really learned over a couple decades is what I call staying power. It's really easy to say, hey, I'm a real estate investor and I'm doing great when a market's appreciating.
Yep.
I know people that, just threw darts and were brand new and just got out of a real estate seminar and did really well from 2014 to 2017 coming out of the Great Recession because, we had double-digit annual appreciation. That's easy. What's hard to do is figure out ways to have staying power when a market's difficult.
Yes, exactly right. It's exactly right. All right, so let's kind of describe this strategy, and let's do it high level, Jake, for the sake of time. But I'll take a swing at it and then clean this up for me.
You got it.
So what we did when we made this offer to the seller is we said, hey, what kind of mortgage do you have on the property? And the seller, I'm going to go back to sharing my screen here. I just lost this share button. Bear with me. The seller on this particular property, as it turns out, you see the mortgage statement on this, Jake?
Mm-hmm.
Okay. So as it turns out, back in 2020, the seller took out a $288,000 mortgage at 3.375. 3.375 is a lot better than 7.5. So we said, okay, we kind of like the sound of that thing. And we were able to essentially go to the seller and say, listen, we're willing to pay the $400,000 price. We will give you cash for the difference between the $400,000 price and the current principal balance of your mortgage, which is essentially $270,000. So we gave them $130,000 in cash, and we said, but we want you to leave the mortgage on the property for at least 5 years, meaning that we will buy the property, we'll take title to the property, but the indebtedness that you owe your bank is going to remain on the property. Now, there's different words for this. Some people call it subject to finance or subject to acquisition, because you're acquiring a property, the title of a property, subject to the existing financing that's there. Other people call it an all-inclusive trust deed, because basically how it works with the title company is the title company transfers the ownership, which is the title of the property that's recorded at the county recorders, over to our name. And then we owe the seller a mortgage that is equal to the amount that the seller owes to their mortgage company. So they call it an all-inclusive trust deed because the ownership structure is wrapped around the underlying mortgage. So when we go to sell this property, or when we go to refinance this property, the title company will look it up and say, yep, you guys are the owners. We see that. You owe a mortgage to the seller, and the seller owes a mortgage to Wells Fargo or whoever that bank is. And when we go to do something with the property, sell it or refinance it, we'll pay off the seller. The seller turns around and pays off the bank. And the reality is the title company takes care of all that. So the money never really gets to the seller. It's just transferred into the title company. Jake, why don't you clean that up for me a little bit, and then we'll kind of get into the real advantage of this subject to financing, because it's more than just a lower mortgage rate.
Yep. So in history, there's a term that gets confused with the terms Josh went through, and it's called an assignment. And throughout history of real estate, it was quite common to say, what does this owner of the property, what's their mortgage terms? And will the bank that holds the mortgage, let's stick with Wells Fargo since Josh mentioned that, will Wells Fargo assign that mortgage from the current property owner to us? Okay. And so I still hear people saying, well, I'm looking for an assignment. I'm looking for an assignment. To be short and swift here, you can still find that in some commercial financing, but that's virtually not an option on any residential financing. Okay. And what we just went through is a way to accomplish the exact same thing, but it's not an assumption. You are not assuming the owner's mortgage, and you are not relinquishing them from the right or the indebtedness of that mortgage they have with Wells Fargo. Okay.
Exactly.
So therein comes the term, wrap or all-inclusive trust deed.
Yeah.
I would say that's the first thing. The second thing I just want to say really briefly is that most new investors will take, say, a townhome community like this in a softer market, and they'll go, okay, there's 400 townhomes here, and there's 6 available for sale, and they're all 400 to 415,000, and none of them cash flow. And their analysis stops right there.
Yep.
And we, in this type of transaction, we're able to still pay the seller kind of the going rate. We didn't get some steal on purchase price.
We got an okay deal, but not a great deal.
Yes, a very fair market deal. So, when we're deal junkies, you'd think, well, I'm only going to buy a deal if it's a really good deal. True, that's still a fact. But there's other factors to the deal besides purchase price that matter. So that's where we had to dive a little deeper with a seller and go, all right, we might be able to pay you market or what you're asking, but what does your mortgage look like?
Yep. And Jake, 2 more clarification points. Those were great. Thank you for that. The way the payment works, because people, if I'm the seller, I'm nervous that, oh my gosh, are you actually going to make this payment? So here's how it works. You hire a company called, we hired a company called Escrow Specialists. And Escrow Specialists, we set up an account with them where every month we pay Escrow Specialists. Then Escrow Specialist turns around and pays the seller's mortgage company and then confirms to the seller, hey, payment received, payment made. And the seller can actually log into a portal with Escrow Specialists, see that the payments are made every year or every month. And if they're late, the seller is notified. So that is important because if you're going to do one of these deals, you don't want to send a payment to the seller who's already got all their equity out of the property. And if they quit making the mortgage payment, they could essentially, steal that money. So you don't want to pay the seller. And the seller really wants to know there's some third party making sure these payments are actually getting made. So that's one important piece to understand. Jake, were you going to jump in and say anything else there?
Yeah. On that note, you might assume, as we've gotten this far in this presentation, that you are looking for a desperate seller or you're looking for, let's say, a not astute seller that you can maybe pressure them to do this. I will tell you that this seller was not desperate. He's well-to-do and he's an attorney. So he definitely, he probably read the documents, more than I did, to be fair. So he knew what he was getting into, and he was extremely, crossing T's and dotting I's on how is this going to work. And so we were able to give him a comfort level with what Josh just walked through, that, hey, we're not going to miss a payment. You're not going to miss a payment. A middleman will take care of that.
Great point. Great point, Jake. And last but not least, the question that comes up on this is, well, wait a minute. Isn't there a clause that says that the seller can't sell the property without paying off the mortgage? No. People misunderstand this clause in their mortgage agreement. It's called the due on sales clause. And if you read the clause, the mortgage company cannot preclude you, or the mortgage lender cannot preclude you from transferring title of your property. What it says is, if you transfer title without paying us off, we reserve the right to call your mortgage note due. But if you understand how mortgages work, these mortgages, this $288,000 initial mortgage is bundled with a tranche of 10, 50, $100 million in mortgages. And it's sold to some pension fund. It's owned by the California State Retirement Fund, or it's owned by the Stanford Endowment Fund. Do you think that CalPERS or Stanford gives a rat's ass about who's making the mortgage payment? They don't care. Yep. What do they care? That the mortgage is paid on time, that the property is kept in decent repair, and that there's a valid evidence of insurance that shows that if the property burns down, there's enough insurance to pay off the mortgage amount. So
Josh and I have mentored with somebody who has written a book on this process and done over 1,000 transactions, and said that in her entire career and over 1,000 done, there's only 2 times. One was a separate situation, but that was called into question, and that a mortgage had to be paid off.
And she's done over 1,000 transactions, but she also wrote a book 20 years ago. She just rewrote the book. In fact, Jake, could you mind Googling the book and drop it in the chat? So we'll put that in the show notes.
Yep.
Her name is Wendy.
Wendy Dalton?
I think it's Patton, but I'm not 100% sure.
I'll find it.
We'll find it for you. But she said, look, I've been teaching seminars on this topic and writing books for 20 years. And I've done 1,000 of them myself. And I think the number was 1 or 2 that ever got called due. So if it did get called due, you would have to refinance the indebtedness, or you need to sell the property and pay off the mortgage. Usually they're going to give you 90 days or something like this. But it was funny in her presentation she was doing that Jake and I were at, people kept asking her, but aren't you worried about, you've got it? And she's just like, look, stop asking me this question. She's like, it is so low risk. We're just wasting our time talking about this anymore. There's a lot of other stuff that you need to know, but stop asking me that question. It's a non-issue. You're more likely to get run over walking to your rental property or hit in a car accident than you are having a note due. Like, stop it. Yeah. It was just hilarious. Yeah. WendyPatton.com. Thank you, Jake.
You got
it. And then you can also Google her. She just re-released her book that is titled something to the effect of Subject to and Seller Financing. But she's a great resource to get really granular. All right, Jake, let's get into the deal analysis. Yep. Let's get into the good stuff. All right. So here's what we want to teach you. The payment on this was $14.94 a month. This was the past due amount when we acquired the property. There was a payment they were waiting for us to buy it. So there was a payment that was past due that had to get taken care of. But the normal payment was $14.94. Of that $14.94, there was $757 in interest, $515 in principal. So every month when that tenant pays us, we pay escrow specialists, and then they pay the mortgage, $515 comes off, and then $221 goes into escrow for taxes and insurance. We were able to rent this property just earlier this month, and
a little further down, $21.95.
Yeah, the rent amount was $21.95. So we banked a prorated rent for January, $21.95 deposit. And then, and so we banked and then a common area fee and a pet deposit. So we were able to bank $3,850 plus $21.95 monthly payment, and then we turn around and make the $14.94. So if I take $21.95 and I minus off the 14, let's just round up to $14.95, shall we, Jake?
Yeah, $700.
$700. So check this out. $700 a month cash on cash return plus $500 a month principal reduction. If the property doesn't appreciate at all, that is a $1,200 a month positive gain that we have, right? The cash flow goes in the checking account. The principal reduction goes into the savings account, as I call it. So if we take $1,200 a month, we times that by 12 months, that's $14,400 per year in forward gain or momentum there. If we divide that by the $130,000 that we put down, that gives us right there a return that is double digit. That's an 11.07% return. And then of course, we would have some appreciation over time as well. So Jake, let's jump into, I'm going to pause here for a minute. I want to show the amortization calculator and teach people how powerful low interest rates are to amortization of your loan. But is there anything you want to jump in and share before I get here?
All I want to say is that for anyone listening or watching, Josh is truly an expert at what he's about to tell you. And this is the number one reason that real estate is the best investment of all time. You talk to really any investor, and it boils down to real estate. You talk to most business owners after a 30, 40-year business run, and they'll say the best investment part of their business was not selling a business, it was paying off and selling their real estate. And what he's about to show you is the underlying reason that that works.
More average everyday Americans have become millionaires through real estate than any other investment ever, bar none, period. It's just one of those things that if you just get into the deal right and you let time to work its magic, you're going to become wealthy. So here's what I want people to understand. Amortization, which is the pay down of your mortgage indebtedness, is a powerful piece of the wealth equation in investing in real estate. And there's this little unknown thing about amortization. The lower the rate of interest, the more of your payment goes towards principal. It's a little counterintuitive, but let's walk through this. So I put in this $288,000 loan amount, 30-year fixed, 3.375. And then if we look at an amortization chart, you'll see that in the first year, you're paying about $470 a month towards principal. In year number 2, you're paying about $490 a month, give or take, in principal. It goes up each month, right? More goes towards principal. In year 3, we have about $500 a month going towards principal. And then in year 4, you have as much as $520 a month going towards principal. In fact, if you look at the amortization chart, we're right here in that amortization chart. We're this many years in, because this mortgage that we took over or acquired the property subject to this financing, that loan was taken out in 2020. So we're now in the 4th year of the amortization, and the month that mortgage statement was created, there was $515 that was going towards principal.
Side note, guys, that's another reason wraps can really work is I think most people would not even think about, or if they got the mortgage statement and looked at the payment, they'd say, okay, what's the person's interest rate? But what's also a factor is how many years are they into that mortgage? Because then you're going to have greater principal reduction.
Correct. So if I took out, if I took over this mortgage and that person would have taken the loan out in, let's just say they closed on January 1st, 2024 at a 3.375 rate, I'd only be paying $460 each month towards principal. So I get the rent from the tenant, I pay the mortgage, the balance of the mortgage would have went only down $463. But if I buy a mortgage that's 3 years in, I'm paying over $500 a month towards principal. So the longer that mortgage, the longer time horizon in the past that mortgage was taken out, the better. So in other words, I might buy one of these deals where somebody's 15 years into a mortgage and they have a 6 or 7% rate. That actually might be a better loan than taking out a new mortgage today at a 7% rate, because the way that an amortization, you can see, like in this graph right here, right? The bottom section is the interest. So it's heavy loaded in interest in the beginning. And the blue upper section is principal, and it's heavy loaded in principal. So if I could take a loan that's 20 years or 10 years in, or let's call it 20 years in, that'd be 2044. You can see at this point, there's $900 a month going towards principal and only $363 going towards interest. I'd take that mortgage over all day. All right, Jake. So again, I will show you the other reason why buying these properties subject to the mortgage is so powerful. Quick reminder, year number 1 at 3.375, roughly $470 a month goes towards principal reduction. Now, let's go up here and say, all right, well, what if I would have taken out a new mortgage? And what if that mortgage would have been 7.5%, which it was in the 4th quarter of 2023? Well, now I'm only paying $220 a month towards principal.
Not only is the payment higher, y'all,
because
of the interest rate, but less than half.
That's exactly right. The payment's $2,013 a month. But of the 2000, and that's just principal and interest. And of the 2013, you only have $220 going towards principal. Conversely, at 3.375, the payment, principal, and interest is $1,272. But of the $1,272, $470 goes towards principal. Now you might be thinking, so what? It's only $250. $250 a month times 12 is $3,000 a year. If you hold this property for 10 years, that's $30,000 more in amortization, cash in your pocket when you go to sell this property that you yield from taking an assumable loan versus getting a new loan. Plus, you had cash flow the whole time. I mean, it's not even a deal. There's no way that this deal makes sense from an investment standpoint without the assumable finance. So, Jake, let's pause there for a minute and see what other comments you want to add here.
I would say at this point, if I was listening to this, I would say, okay, awesome. That makes sense. How do I find these deals? Who am I looking for? Why would somebody do this? You know, I would say every active for sale property that's sitting on the market in your marketplace that's been on the market for over 30 days and they haven't reduced price is an opportunity. And nobody, in my experience, there's no agent or consumer that's approaching those sellers going, all right, your price seems relatively fair, but it's still not selling. And right there, most agents just go, so we need to lower price or I'm going to give you a lower offer. And instead, if you approach with the message, we might be able to come in around that price, but let's talk about your mortgage. And if you can get people to open up, it's highly likely, you have an extremely high chance that they have a rate at somewhere between the high 2s and 4.25%, because everybody and their dog in the last decade refinanced or purchased and got that low rate. That is the primary reason that inventory is so low. Yep. And we really haven't seen this kind of environment ever before in the history of the United States. Sure, we have had interest rates go up and go down. Sure, we've had periods of low inventory, but we haven't had an extended over a decade-long period where virtually everyone on their principal residence has that low rate. Yep. And the reason they don't want to sell is not because the job market's bad, not because they can't afford to upgrade. It's because they don't want to exchange their current interest rate for what the new rate's going to be.
That's right.
So those that are willing to sell in a low inventory market typically have a reason, job transfer, something like that. So this is a whole nother arena to explore that nobody's exploring.
And Jake, here's a couple of interesting statistics. 1/3, it's estimated based on title data, that 1/3 of all residential real estate properties in the United States are owned free and clear. Mm-hmm. Of the 2/3 of homes that are left, 80% of the 2/3 that are homes that are left that have mortgages on it, I should have said, 80% of those mortgages are 5% or less. And most of those that are over 5% are probably bought by an investor, not an owner occupant. Yep. The numbers have to be much higher as a percentage for owner occupants. So really, there's a tremendous amount of opportunity out there that somebody might sell. And I will tell you this, people are more connected to the price. You know, when you spend 10 years in your house and you changed the light bulbs and you painted the freaking cabinets with lacquer. Do you remember how hard that was? That sucked. You know, everybody has this opinion that their house is worth more than the neighbors because of all the things they've done to the house. And people get really emotionally connected to the price.
No doubt.
So what Jake and I are offering is perhaps instead of offering to negotiate the price, negotiate the terms. And if you can find someone who's willing to leave this mortgage on for 5, 10 or longer until it's paid off, leave their existing financing, you've got some significant advantages. One, you can buy properties and actually have a positive cash flow. 2, the lower mortgage interest rate means more payment that is going towards the principal. And 3, if they're multiple years into the amortization, that means that a lot of the interest is behind them and more of the payment is going towards principal. And I'll give you a fourth one. The fourth one is, it was incredibly hard to get mortgage financing when I had 63 single family homes. You don't have to go through the mortgage process. You don't have to worry about getting a bunch of mortgages reporting to your credit. It's a bit of a hedge against a worst case situation for an investor.
Yep. Yeah. That's an amazing point. We haven't even brought that up, but not having to go through the mortgage process is pretty amazing.
Exactly.
And that's another negotiation tool that you have with a seller like this, which is, hey, we've got the cash. In the case of this townhome, it was his equity position was 130,000. We said, we've got 130. We can wire that to you tomorrow, as fast as you want it. If we can work out this type of deal, and you can do a transaction like this very quickly.
Yes, exactly. Right on, man. Well, let's we've got about 10 minutes.
Yep.
So what other important pieces of information do you think that somebody would need to really analyze and get into this? Any other tips, thoughts, anything else valuable you think we should share?
I would say, let's talk about roadblocks for a minute.
I like that.
If I were to, with my local MLS access and my expertise, if today I wanted to start, reaching out to people or just making offers that were wraps or subject tos like this, I could go down a lot of different avenues and rabbit holes of how to find a property. I could search for the zip code area I want, a price range I want, and just start making offers. That part's easy to do. The roadblock number one is you will have a hard time getting listing agents and or their clients just sending you back a copy of their mortgage statement. Okay. So I think to overcome that, the first thing you have to have is a basis of knowledge that we're discussing here. How might this benefit the seller? And, we've glossed over that, but to give you my quick highlights, number one, you can be more flexible on price. And that's not just you being a softie on overpaying for a property. That's saying that there are some other factors that in your long-term investment would make this better than getting a lower price in many instances. So, but that's the dangled carrot. That's the first dangled carrot you can say to a seller that's going, wait a minute, share you my mortgage statement. Why? How would this work? Well, I will likely be able to pay you a better price than anyone else is willing to pay. The second thing is what we just said, so I won't say much about it, but it's just speed and time and easiness of transaction. Okay. A lot of people are interested in that. A lot of people have seller fatigue once their property's been on 60, 90 days. And it's been a good decade since we've had properties on that long. And so that's a good opportunity. What I would look for specifically, if I was playing the time game, is properties that have been on, I'd say 60 days or greater where you want, that also have not had a price reduction. That means, typically I'd look for a price reduction, but that means the seller's kind of being a hard head and is pushing for that price. Okay. Then the last dangled carrot that you would have with people that really takes the most explanation is, again, we got to put our seller hats on to say this, but is to say, look, it hasn't sold in X amount of time frame. I want to be able to pay you better than anyone else on price, and we can make this a fast and smooth transaction. But seller, what is your reason for selling? Are you staying in the same market? Do you need to upgrade? What's going on here? Because if you can get those quick, simple answers, that empowers you to say, as was the case in this attorney that we acquired this townhome from, he wasn't trying to just sell this townhouse and upgrade to something else in our market. This was an investment for him. And his ex-wife was the tenant. Okay. And so he just wanted to pass the baton to someone else, not be in charge of the payment anymore. And he lives in Arizona and was trying to purchase a condo that he was leasing there, and kind of just wanted it all cleaned up. So it does make a big difference when you can resolve some of these problems for a seller. And trust me when I say, they're not talking to anyone else that comes in with these angles.
Such a great point. We have self-interest biases. We think about everything from our self-interest, from our perspective. But what you're saying is take that hat off and pretend you're the seller. What problems is the seller experiencing? How
Yep.
can you structure or negotiate terms rather than price that solve the problems for the seller? And they go, wow, if you can take those three problems away from me, yeah, I'll do that. That makes sense. But you really have to think through this scenario from their perspective.
There's
Jake,
one other tiny nuance, Josh, that I want you to address because you're far more the expert here than I. But if you get this far into a process with a seller and they share a mortgage statement with you, I'll almost guarantee that at around this point, they will say to you, wow, all this is sounding pretty good and would resolve my problems. But what about that existing mortgage that I'm not paying off? Does that stay on my credit? Does that affect my debt to income ratio on my next purchase? How's that going to work?
great call. Yes. So first of all, a mortgage on your credit is, as long as it's paid as agreed, is going to help your credit score, not hurt your credit score. Because the longer you have an installment loan open and it's paid as agreed, it's telling the credit algorithm that you are consistent in your ability to repay the debt. So from a credit standpoint, as long as you're using that escrow specialist or another company like that that is handling the payments and making sure that they're made, it's positive, not a negative. From a debt to income ratio standpoint, once we can prove that the seller's mortgage payment is being made by somebody else and there's a track record there, you can offload that from the debt to income ratio perspective for them qualifying for a new property. So it should not inhibit them from going out and buying another home. Now, there are rare instances where there are certain first-time home buyer programs that say you can't have owned a home for three years to qualify for this grant or that type of program. So in the rare instances that somebody was applying for that type of loan, it could be an impediment, but it would really be more the exception than the rule. And certainly there would be a financing vehicle to get them into a house.
Yep. Great.
So Jake, I thought we would maybe end on this, and then of course we'll share your contact information with everybody and anything else you want to share with them on how to get a hold of you. But I find that when markets get tough, sometimes investors can get a myopic or short-term investment outlook. They start looking days, weeks, months, a year ahead of them instead of taking a long-term perspective. And any of those of you that are watching along with us live or watching this video recording, I'm now sharing my screen. And what I'm showing you is the Case-Shiller housing index values. These are the values of residential real estate nationwide, going all the way back to the 50s. And what you'll notice as we go through this deck, actually, I'm going to switch to a different slide deck because I have one that I think right before this goes back to the 40s. Yeah, here we go. Okay. So this goes back to 1942. And what you can see in every year next to it is the average, the average rate. This is the mortgage rate at the time. And then the amount of appreciation or depreciation. Appreciation, residential home values went up. Depreciation, residential home values went down. And you can see that from 1942 to 1962, mortgage rates ranged from 3.75 to 5.25. And there wasn't a single year that home prices went down. In 1955, home prices were flat, but every year was positive besides that. From 1963 to 1983, mortgage rates went from 5.16% to 13.24%. And every year from 1963 to 1983, real estate had positive appreciation. From 1984 to 2004, mortgage rates went from 13.8 to 5.84. So the cycle kind of turned and rates went down. And the housing market was positive 18 out of 20 years. Only 1990, home values were down 1%. 1991, home values down 0.1%. Every other year, positive appreciation. And it's only the Great Recession, 2007, 8, 9, 10, and 11. It's just that 5-year span where we really saw negative appreciation, down 5%, down 12%, down 4%, down 4%, down 4%. But if you look at it from a decade perspective through the 2000s and the 2010s, if you were able to stay in your investment through that period of time, you still had positive appreciation for the decade. So if you look at 2000 to 2009, 66% cumulative appreciation despite bad years in 7, 8, and 9. And then the 2010s, 2 years of negative values or depreciation, down 4% in 2010, down 4% in 2011. But for the decade, 2010 to 2019, 45% positive appreciation. What's the point? The point is that over long periods of time, you're going to do very, very well with real estate appreciation. And if you can buy a property subject to a 3% mortgage rate or a 4% mortgage rate, you are going to pay down that mortgage quickly, have positive cash flow, and you're going to do extraordinarily well over long periods of time. Jake, I will turn it over to you to close us out, my friend, and share your contact information with everybody.
Yeah, you got it. This is just a walkthrough in other angles and unique ways to look at investing in real estate. And, I'll wrap how we started. There's always opportunity, and there's even more opportunity. I know it's cliche, but there's more opportunity when others are fearful. What Josh was just walking through, I could quote you the numbers for my personal market, and we don't have time to do so. But in short, we were a shorter downturn, a little bit larger downturn, 34% in median price in a 4-year period. Everybody remembers that. What they're quick to forget that it was 2 years and 1 quarter after the end of the recession that prices were back to where they were at the peak all-time highs prior to the recession. So it's I said this early today, but that is called staying power. That's the term I use for that. And when you can think outside the box and you have staying power, so far in the history of tracking all things real estate, you'll do fine. And so we believe there's always opportunity, and we can help you find those unique opportunities. I just put my contact information in the chat. You can find me at Utah Cribs. Yes, I know we created it in the 90s. That's after MTV Cribs. We can't change it now. People know us for it, but it's utahcribs.com. I'm found at jakebrean@gmail.com, and my cell phone number is in the chat as well.
Jake, thanks so much, buddy. I think this was really valuable. Hopefully we inspired somebody to take action and look at the market just a little bit differently. There's always opportunity, and winners find ways. That's a wrap for today. Thanks for joining us. It's great to be here with you on the Infinite Financial Freedom Podcast.